Every year, banks make billions of dollars from fees you probably do not even notice you are paying. Overdraft charges, minimum balance penalties, interest rates on credit cards that quietly creep upward, late fees that trigger the moment you are a single day behind. For decades, the average person had almost no way to catch these charges before they happened, because banks controlled the information and banks controlled the fine print. That is starting to change, and it is changing faster than most people realize. Right now, nearly half of all consumers say they have already used an artificial intelligence tool like ChatGPT, Gemini, or Claude to help manage some part of their personal finances. And that number keeps climbing every quarter. This is not just younger generations either. A large share of Gen X and even baby boomers say they are open to letting an AI tool look over their spending, their credit, and their investments. That shift matters more than it sounds like on the surface because, for the first time, the average person has access to the same kind of financial analysis that used to require paying a professional advisor. Here is why that threatens the traditional banking model. Banks make a huge portion of their profit from confusion. If you do not know your credit card interest rate is about to jump after an introductory period ends, you pay more. If you do not realize you are one purchase away from an overdraft fee, you pay more. If you do not compare your savings account rate to a competitor down the street, you earn less than you could. None of this is illegal. It is simply built on the assumption that most people will not take the time to dig through statements and terms of service looking for the details that cost them money. An AI tool does not get bored reading fine print. It does not get confused by financial jargon designed to sound complicated. You can upload a bank statement or describe your accounts and ask direct questions like whether your interest rate is competitive, whether you are paying fees you should not be paying, or whether a specific credit card is actually a good deal once you account for the annual fee. In minutes, you can get an answer that used to require either hours of your own research or an appointment with a financial advisor who might charge a percentage of your assets just to have the conversation. This does not mean you should blindly trust every answer an AI gives you about your money, and it does not replace the value of a licensed professional for major decisions like retirement planning or estate planning. But for everyday financial hygiene, catching fees, comparing rates, understanding a confusing bill, or building a basic budget, it closes a gap that used to only benefit people who already had money to pay for expert advice. The information advantage that used to separate wealthy households from everyone else is shrinking. And that is a genuinely big deal for anyone trying to build wealth from nothing. So how do you actually put this to work instead of just nodding along and forgetting about it by tomorrow? Start with your bank statement from the last 3 months. Look for any charge you cannot immediately explain. Overdraft fees, maintenance fees, subscription charges you forgot you signed up for. Ask an AI tool to help you understand what each one means and whether it is avoidable. Most maintenance fees can be waived entirely just by meeting a minimum balance or setting up a direct deposit, and most banks will not tell you that unless you ask. Next, look at your credit card. Ask what your current interest rate is and whether it is considered high, average, or low compared to the market right now. If you are carrying a balance month to month, even a small difference in interest rate adds up to real money over a year. This is also a good moment to ask whether a balance transfer card with a promotional 0% period makes sense for your specific situation, since that is one of the most underused tools for getting out of credit card debt faster. Then, look at where your savings actually sit. A shocking number of people keep their emergency fund in an account earning close to nothing, while high-yield savings accounts at other banks pay several times more with zero additional risk. This is not a complicated investment strategy. It is free money you are currently leaving on the table because switching banks feels like a hassle. It takes maybe 20 minutes to open a new account online and set up a transfer. Finally, use these tools to build a real budget instead of guessing. Describe your monthly income and your recurring expenses and ask for a breakdown of where your money is actually going versus where you think it is going. Most people are surprised by the answer. Subscription services quietly drain more from the average household than people expect because they are small individual charges that never feel significant until you add them all together. None of this requires expensive software or a financial advisor on retainer. It requires being willing to actually ask the questions banks have never encouraged you to ask. The tools that used to be locked behind expensive advisory fees are now available to anyone with a phone and a few minutes of curiosity. And the people who take advantage of that shift early are going to be the ones who quietly get ahead while everyone else keeps paying fees they never had to pay. Money management has never been about being a genius with numbers. It has always been about paying attention to details most people are too busy or too intimidated to look at closely. The gap between people who build wealth and people who do not was never really about income. It was about information. That gap is closing right now, and the people willing to use the tools available to them today are the ones who are going to look back in a few years and realize this was the moment things started to change for them financially. If this helped you see your own finances a little differently, subscribe for more breakdowns like this one, because the goal here is simple. Give you the tools the banks hoped you would never ask for.